Good afternoon, I'm Bridget Taylor and this is Currency Wars. Joining me on the desk today is Andre Eerenstein from RMB as well as Andre Cilliers from Treasury One. So let's have a look and see what happened in the markets this week. This week saw the tale of two central banks, the Federal Reserve from the US and the People Bank of China. Markets have reeled after the People Bank of China pulled a rusty lever by devaluing the yuan by 2%, triggering the biggest sell-off in 21 years as global markets try to make sense of this move. The Chinese fixing rate dropped 1.1% earlier in Asian trade and has recovered slightly after sliding 2.8% in the last 2 days, trading currently around levels of 640 from 622 a week ago. Is this move as dramatic as the market initially thought? And that's our big question today. Because Chinese gross domestic product has been deteriorating for the past 3 years, so this is something that we certainly know. But from levels of 8% in 2012 to current levels of 7% this year. And this continues despite the monetary policy stimulus lever that has been previously pulled. The export sector has come under significant pressure due to the stronger currency, and short-term control by the People Bank of China looks like a valid step to curb the growth deterioration. If this doesn't in fact stem that deterioration, they will have to consider pulling a fiscal stimulus lever at some later stage. Meanwhile, across in the West, in the US, there's debate around the move by the PBOC and its impact on the US Consumer Price Index. As the Fed's rate decision comes in September, this has caused further volatility in the market. And the continued weakening of the oil price as the dollar remains strong could pose further risks to the Fed's inflation target of 2% and push out the rate hikes to later in 2015. Meanwhile, the rand continues to remain weak after trading 1260 and a high of 1287 briefly, post the PBOC decision on Tuesday. However, it has recovered slightly towards this stage this week. Right, now that we know where we stand, I'm going to put it to the guys on the desk and pull out the big guns. Andre and Andre, welcome. So it's been an interesting week. We never ever have a boring week in financial markets, but certainly on the currency. And I love the fact that a lot of people were commenting about, is this a currency war? And that really speaks to this show because it is about how those various economies try to position themselves in an environment where there are a lot of pitfalls and there certainly are a lot of issues that plague global growth currently. So if we look at the Chinese debacle that we've seen this week, what is your view? Just give me your quick overview. I mean, this has been spoken about ad nauseum. Do you think this was a good move? Do you think it's just a quick decision? Or do you think this is going to be a continuing kind of factor that we're going to have to factor in terms of pricing our currency?
Well, when it comes to the Chinese central bank, nothing's a quick decision. I think it's well thought through.
Yeah.
When they look at the state of the economy, if you look at underlying export factors in China, it's really pointing to a currency devaluation as the only real solution for them.
Yeah.
And I think they made that decision, and I think they will do it. If there's persistent weak data coming out of China, I think yes, I think there's a chance that they will do more.
Do you think that was spurred on by that export data that came out earlier this week? I mean, it's quite a significant number in terms of the deterioration that they've seen. Yes, they've tried to bring their economy back towards driving the consumer spending, and obviously that in the longer term will speak to a better scenario if their currency is stronger, if they're net importers. However, for now, they still continue to be a net exporter, or certainly have the advantage in terms of their exports. So just talk to us in terms of your view of the strength of the yuan that we've seen, and whether this is as significant as the market has potentially seen.
I don't think that the move of 1.9% and 2% is that significant and will change things that significantly. It's a start of a process to curb the decline of growth in the Chinese economy and make them more competitive. We have seen that their production costs are rising, labor costs are rising, output is lower, but also that the world is battling. If the world's battling, then the Chinese economy will battle. We've seen commodity prices being under pressure. So if you look at this move, is it really that bad? If you get the Chinese economy growing again, it actually helps commodity prices, eventually helps South Africa, eventually helps the rest of the world.
I think you've hit the nail on the head, Andre. I mean, in my view, you know, we all speak about the fact that the Chinese economy has in the past certainly been an economy that's continued to grow, offered that growth potential. And yes, it's a massive economy coming off a low base, so they need around 7.5% just to kind of keep its status quo. It's negative for the global economy if the Chinese economy goes into deterioration. So from that perspective, why has it been taken as such a bad move in terms of this fallout in the market and this huge knee-jerk reaction that we've seen?
Well, I don't think it's been a massive knee-jerk. I think if we look at dollar rand per se, yeah, the rand is weakened across the board. And it's weak because of our fundamentals are weak. And yes, one of our major trading partners is starting to pull some stimulus out the hat. But I don't think it's a significant move, and I think things will correct.
They will, and we're already seeing that today. If we look at the Asian markets today, they're starting to come back within, the better trading ranges. I mean, if we look at how the rand moves, I mean, we look at the yuan. After this huge, significant move, we saw a move from 622 to 641. Yet we see that in a week in the rand. So, it kind of exactly. It just reminds us that in South Africa, I think we're kind of used to those huge volatility levels. When you're looking at the likes of the euro, etc., it's less likely that you're going to see that kind of significance. So let's bring ourselves back to this Fed rate decision, because a lot of market commentary that we've seen, and certainly a lot of analysts looking at the September decision, a lot of people already pricing that in as a given based on the last FOMC statement. However, what we are seeing is that sub-50 level on the on the oil price, as well as the continued strength in the dollar, that does pose those risks to that 2% target that the Fed has. What do you think in terms of that outlook? Do you think it's starting to shift a little bit, or do you think we still have to remain very cautious?
I think we can remain cautious, but I've all along said I don't think September is the month. It's closer to the end of the year.
You're on your own because the market thinks so.
First quarter next year.
Yeah.
And I'm going to stick to that, because with an oil price coming down, and I think that poses more risk to lower inflation in the US than the actual devaluation of the Chinese currency.
And how do you justify a hike if there's no inflation, right? So I think that's the conundrum that the Fed's faced with, and that's probably going to be the biggest risk factor to consider when it comes to preempting when we think interest rate hikes are going to happen.
Yeah, I think what's very clear is the Fed actually wants to get off zero.
Yes.
And I think whether they do 25 basis points, and if they do it in September, I don't think it's a big deal. I think what's going to be a big deal is the language, and and I think with inflation dropping going into next year, and that's core and headline, I think the Fed's language for future rate hikes is going to put into question. I think they need to build a war chest in terms of stimulus. That's possible. If the global economy does fall off a cliff, what do they do?
No, exactly. That's the point. And I think that's really been the key with regards to this decision around PBOC. It's really alerted us to the fact that nothing has changed in the global growth scenario. In fact, if anything, that deterioration continues. And this is something that we're finding in South Africa. We're finding it across the board in most of the developed world. And now you're starting to see it play out with the likes of the Asian economies. I mean, we saw the stock markets get absolutely carried out over the last few days, particularly in Asia, particularly those that were geared around Chinese, opportunities, particularly in those more durable goods or those high-end good type markets. So let's look at where we're going to from here. I mean, we've got a few data numbers coming out, both out of China as well as the US, the US retail sale figures, etc. Do you think that there's going to be a calm that's going to come to the market now, and everybody's going to just reassess the value on their positions in terms of their portfolios? Or do you think that we're going to have a shift out of that view for the potential rate hikes and the impetus that people have placed on those for the Fed?
Well, I think you've seen, if you look at US Treasuries rallied, I think they touched on 205. So yes, I think there was a rebalancing into longer end bonds. Yeah. But I think data is volatile, and I think we need to see how this all pans out. We need to see how the Fed reacts. And I think once we have a little more certainty, I think then we might see asset shifts out of the equity market.
Okay. And then lastly, just before we bring out the big guns, Andre, just give us your view in terms of the South African rand specifically. If we look at the commodity price rally that we've seen over the last few days, particularly in the gold price, we are in a scenario where we are viewed as a commodity-based currency. However, we're not necessarily the biggest exporter of commodities, but we benefit from those types of moves. Do you think that this decision by the PBOC will see a continued rally with regards to those kinds of precious metals as a hedge, or do you think that that's just a short-term play? I
don't think we're going to see a rally. I think we might see a stabilization of commodity prices, leveling out at these levels, but by far and definitely not a rally. We would have to see a Chinese economy turning around and increasing their growth levels before you'll see a change in commodity prices.
So we need that sustainable feed-through in terms of the
decisions.
You need
some sustainability. Yeah. I think we need to also mention that we are sitting in August.
Yeah.
So, this is the December of the Northern Hemisphere.
Yeah.
So we're also speaking about relatively thin markets and a lot of traders on leave. So your moves at this point could be a little bit overdone and could see some change to normality in September.
So I'm going to now put you on the spot. We're going to have a look at all of that information that we've quickly unpacked in the last 10 minutes, and we're going to pull out the big guns. Right, so this is it. I am going to start with Andre today. Give us your views just in terms of obviously the rand's been quite volatile, but just give us some trading ranges and your trend outlook, if you can, as well on the crosses.
On the dollar rand, I'm going to say 12.60 and look out for the 13 level. I think we might touch it. I don't think we'll break it, but it's a very close call as to whether we'll see it or not, but I do think we will. On the cross rates, look for the euro rand trading between 13.95 at the moment, is on the upside around about 14.25, and the pound hovering around the 20 levels, 19.80, 20.10.
Scary times. And you, Andre?
For me, it's an opportunity. Any dip that you see is to buy. Yeah. I think we'll see on dollar rand. I think 70 is probably bottomish, and I think we will touch on 13. Euro rand, same story. I think we will maybe get to 14, but if it is a buying opportunity. And sterling rand is a volatile one, so I think around the 20 level, I think there's bias to go higher.
Thank you so much. I really appreciate your views, guys. So in conclusion for the week, we're still looking for much more weaker levels on the rand, looking for a support around that 12.60, 12.70 level. But both our guests today suggesting buy dips. That's in euro rand, that's in dollar rand, as well as in the pound rand, because the weakness is likely to persist. In fact, if rand trades up to that 13 level, we can expect much higher levels on the crosses. Until next week, you are welcome to send your questions or your comments to @CNBC #CurrencyWars410 or to myself @Bridget R. Taylor for your personal responses to the FX markets. Until then, good luck in the trenches.